All right, here we go. Going to pick up where we left off and build upon last week on income taxes. So, if you remember from last week, talked about a couple forms of income. First, we have gross income, which represents all income we make in the course of the year: wages, salary, tips, interest on investments, any other income that we bring in. From there, we calculate a taxable income by subtracting out from the gross income any money we put to as tax sheltered savings. We subtract out deductions, and our choice was either standard or itemized. And we subtract out exemptions, although over the last two tax years, we have not allowed exemptions. They raised the standard deduction rate, so people didn't subtract exemption. So again, our ultimate goal in preparing our taxes is to get our taxable income as low as possible so that we owe as little as possible to the government in taxes. Next category is filing status. You have four options. You either file as a single person, you're filing just your income. Second choice and third choice kind of go together. They're both married, but different ways. The second choice is married filing jointly. It means you and your spouse are filing together, so you're adding up all of your own income and going through in that process. Third choice is married filing separately, so you file and your spouse files. And the fourth one is the head of household. Head of household is used sometimes in unmarried situations where there are dependents living in the household. Those are your four choices in filing status. Next question is, when should you itemize when you choose your deductions? Remember, your goal is to get the tax income as low as possible. So we want to itemize only if we add up all the things that we would list as deductions and we get an amount that is higher than the standard amount. By having a higher than the standard amount, we're deducting a larger amount of money, which gets our taxable income lower. So if I gave a bunch of money to charitable income, I had mortgage interest, I had other things I could deduct, and I add them up, and they don't amount to as much as the standard amount, then I would not use itemized, I would use standard. I want the one that is higher because it gets a taxable burden lower. Next term is tax rate. So once we calculate our taxable income by doing what we did above, gross income minus deductions, it puts us into a tax bracket. It's a percentage. There is a chart in your book that shows that. The lowest rate is a 10%. The US has what's called a graduated tax rate, and people are taxed at higher percentage for the more income you make. So the lowest percent is at 10%, and then it goes up and up and up. So it puts you, once you figure your tax income, you figure out which tax bracket you fall into, and that helps you calculate what tax is owed. Looking at tax credits versus tax deductions, we talked about deductions. We're either going to do a standardized or itemized deduction. When we do deductions, it will lower our taxable income, which lowers our tax rate, or that percentage I just spoke about. So you save a percentage of what you deduct, but not all of it. So if I'm in a 10% tax bracket and I got a tax deduction of $1,000, then I save $100 out of the 1,000. A tax credit, on the other hand, lowers your tax by the amount of 100% of whatever you got. Tax credits are often given in incentive type programs, like sometimes they'll give you a tax credit for using solar panels on your home. If you received a $100 tax credit, that will lower your taxes by that $100. So once we figure out what we owe in taxes, we can subtract $100 from that. It's a big difference between a tax credit and tax deduction. Tax credit, you get 100% credit for. Tax deduction, you only get the percentage within your bracket. So you don't get it all. Next question from a tax perspective, is it better to rent or own the house you live in or the apartment you live in or the condo you live in? And here's what you're looking at. When you rent, 100% of what you pay for rent goes to the owner. And there is no tax benefit when you file your taxes. So if I rent, all of my monthly rent is going to the owner. And when I fill out my taxes, I don't even indicate that anywhere on the tax form. When we own, we do get tax advantages. Any interest we pay on the mortgage, which is part of your monthly pay, it's the same as paying rent, but you're paying it to the bank, is tax deductible. Also, all the money you pay for property taxes is tax deductible. A $300,000 home in Portland is probably going to pay $6,000 in property taxes. That $6,000 can get deducted from your taxable income to lower your tax burden. Plus, you're paying monthly mortgage, and a percentage of that is also going to as interest, and all that interest that you pay is tax deductible. So owning helps you in the tax world. So it's better to own than rent. However, your decision is made on whether you're able to afford the down payment on your home. I have a daughter who just bought a home. She's paying the same monthly payment she was paying for her apartment. But now she gets credit and she lowers her tax burden by claiming the property taxes she'll pay and the interest on the mortgage that she'll pay. So she's going to be in a better situation now, but she had to wait till she had enough money to make the down payment. Dividends and capital gains come from stock investments. Capital gains are of two types, either long-term or short-term. Long-term capital gains are gains, profits gained from your investments that you hold for more than 12 months before you sell it again. So if I buy some stock in Apple and it goes up and I sell it right away, that is not a long-term gain and I have a tax burden on it. A short-term gain, a short-term capital gain is profit made within and sold within 12 months of that purchase. So if I bought the Apple now, 2 months from now, it goes up, I sell it again, that's a short-term gain. Long-term gains have a better tax advantage than short-term because they're encouraging you to keep them longer. The last term for this week is tax-deferred income. We've talked about that before. But tax-deferred income is income that you put into some type of a tax-deferred savings plan, which is not taxed now, but it will be in the future when you use it. This is to encourage you to save long-term, particularly planning for retirement. A lot of people will start a tax-deferred deduction from their pay early on so that when they retire, they've got some money to draw from. If you look at the colored graph that was in the posting I had, you can see that if you made a $200 per year investment, $2,000 per year, or about $160 a month towards a tax-deferred income instead of just putting it in some type of a basic savings account. In 30 years, that $2,000 a month, $2,000 per year would grow to $300,000, as opposed to if you put it in a regular savings type account, it might grow to about 200,000. So the advantage of a tax-deferred income is that you save on taxes and the investment makes more money over time. The big decision there is, can you wait that long to have it? That's the key terms and information for this week.